Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. Markets in the Asia Pacific are bracing for the Fed's final policy decision of the year. And in a moment, we'll take a look at the U.S. rate environment with Mark Heppenstall. He is president and CIO at Penn Mutual Asset Management. But we begin in Bangkok, Thailand. It's there we find David Chao, the global market strategist at Invesco Asia Pacific. David, thank you for having the chance to speak with us. It's always a pleasure. And I want to begin with a story that we have been reporting on Japanese car makers Honda and Nissan preparing to begin negotiations on a possible merger. Give me your sense of where the automobile industry is right now globally in terms of what could be described as excess capacity. Is that a fair statement?
I think that's a fair statement. I think that what we're seeing now is a pretty big shakeup in the global auto industry, and I expect further consolidation as well. What we have right now, there's just too much supply for cars, EVs, hybrids, combustion cars out there, and I think that certainly is pushing profit margins to levels we haven't seen for a while. And I think that's going to ultimately drive the consolidation. Whether it's in Japan or in other places. Chinese automakers are now the world's most dominant automakers out there. China makes around 7 to 8 million cars a year, yet the domestic demand is somewhere closer to 2 to 3. So around 5 to 6 million cars need to find homes in other parts of the world. Whether it ends up in places like South America or Africa versus places like the US or Europe, it's pretty clear that China is now trying to make better trade partners now that they've had taxes on EVs under $10,000 in Western countries.
I think the overcapacity story in China goes well beyond just EVs. I mean, there are other segments of the Chinese industrial economy, the manufacturing economy, that also have far too much capacity.
That's right. I mean, we have to remember that China's political economy is a command one, very much set forth by policymakers, compared to in the U.S., where it's more market is driven by market forces. And so the industrial policy in China has been one that they recognize that economic growth propellers for China's economy is slowing. So what are they going to do? They're really going to kind of amp up capital expenditures and investments in manufacturing and exports in order to give the economy a boost. That's before the consumption can pick up. Although the most recent numbers that we've seen from China show that perhaps there could be a little more fiscal stimulus and more monetary stimulus to enable consumers to feel more comfortable buying and consuming in China.
So that takes me to the next question about the stimulus that we have had from the Politburo lately, or at least the messaging of it. What's your takeaway here? Is it going to be enough to move the needle, do you think, especially where consumption is concerned?
I think that it's likely to be enough to start to invigorate the domestic consumption market in China. It's probably not going to be enough, for markets. I think markets still want significant size of bazooka size stimulus, whether it's monetary or fiscal stimulus. I don't think we're going to get that. But this is the first time that we've heard the Politburo address both fiscal stimulus and helping domestic consumption in the same document. And so I think that's a welcome surprise. And I think that in the coming year, GDP growth in China is probably also going to be set around 5%. And I think that more stimulus is likely, but we're not going to get significantly more.
Does it cause you to change your strategy when putting money to work in China? Maybe that's an assumption that I'm making. Are you putting fresh money to work in the Chinese market right now?
I am. I think that the Chinese markets look quite attractive. We know that they are momentum driven. Chinese stocks are down around 10 to 15% from their recent highs. We saw a surge back in September, and we've seen them come down since then. I think that we get another leg up from now and over the next few months. What's interesting is when Trump was elected president back in November, you think that Chinese stocks would get dinged because of his threats of tariff policy, but they actually went up. So I think this time around, Chinese companies and policymakers are a lot more ready for his tariff policy. And secondly, more stimulus is coming online. And thirdly, I think that there could be another leg up relatively shortly.
Hey, David, let's take a look at what's going on in Japan, if we can pivot there. BOJ's got a policy decision at the end of the week. Conventional wisdom right now is that the BOJ is going to do nothing. Maybe they look at something as soon as January, perhaps March of next year before they raise rates again. How are you understanding what the BOJ is trying to accomplish right now?
Well, you're right. I think they're likely to sit on their hands this week. But we know that there's more room for tightening. I think that there could have been a bit of post-traumatic stress from what happened in that September time period, where they caused, where they roiled the currency markets and also stock market because they didn't telegraph the cut that was coming. They didn't telegraph the policy pathway forward. So I think this time around, although the economy, I think, could very much survive and thrive with a hike, I think that the message is more that they're going to be gradual. If we look at the most recent Bank of Japan Tenkan December service, that showed that even small Japanese companies have not felt more stress in their financial positions from the 2 rounds of hikes that we've seen so far. So the Japanese economy is on much surer, sound footing. I think that a hike would not throw a wrench in that kind of economic recovery there. I think Japanese stocks are also attractive because Japanese consumers are finally having, net positive real consumption power, meaning that their wage growth is above inflation, and it's been negative over the past year. So I think domestic consumption is going to pick up. So for those traveling to Japan, to enjoy the week yen over the holiday period, you may have a much harder time getting a restaurant reservation, not because of competing from other tourists, but from actually domestic, Japanese consumers.
And that weak currency has really helped to drive the export economy in Japan. I think in the month of November, exports were up 3.8%. Shipments to China alone were up about 4.1%. A lot of this has to do with chip-making machinery, maybe some non-ferrous metals in there as well. So kind of also helps out Japan Inc., that weak currency.
That's right. I think that Japan is going to start firing on all cylinders pretty soon. The only missing link so far has been domestic consumption, but we're starting to see that pick up. And so you better watch out when they're firing on all cylinders. And Japanese equities continue to be very attractively priced, especially when compared to the U.S. And so I continue to like Japan as my most favored developed market.
Wow.
For 2025.
Hey, David, before I let you go, can I get your view on what's happening in South Korea and what it means for the South Korean markets?
Well, let me just compare what happened back in 2016 when the Korean president was impeached then and what markets did. Actually, markets outperformed the following year, and Korean stocks did really well. And that's because of the semiconductor upcycle when companies were spending money on hard tech. And so I think that leads me to think that Korean stocks, the Korean market, cares more about the global macro dynamics and semiconductor cycle than what's happening from a domestic, political situation. So yes, I think that maybe over the next few months there could be noise, but ultimately it's really the semiconductor cycle that drives Korean stocks.
And the BOK, we should point out, the central bank in South Korea has vowed to kind of guard against instability in not only the currency but financial markets as well. David, thank you so much for being with us. He is David Chao, the global market strategist at Invesco Asia Pacific, joining us from Bangkok, Thailand, here on the Daybreak Asia podcast. Welcome back to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. Fed decision tomorrow, and a quarter-point rate cut is expected. To take a closer look at where the Fed is in its process of lowering interest rates and markets in general, we're joined by Mark Heppenstall. He is the president and CIO at Penn Mutual Asset Management. It's not really going to be a surprise, I think, in terms of the rate cut. Markets are firmly convinced of this fact. One of the things I'm wondering about, though, has to do with the outlook. Where we go from here? What's your sense on that?
Well, that is going to be, I would say, the topical question, because in some ways, the interest rate decision tomorrow is less important than the dot plot, and I would say the economic projections for next year. Because if you look at where markets are pricing in sort of that long-term neutral rate, it's just below the 4% level, about 100 basis points higher than the Fed was projecting at the September meeting. So I think that's going to be the primary focus for investors, where they see the Fed funds rate ending next year as opposed to tomorrow's interest rate decision.
I thought it was interesting because the reading today on retail sales topped estimates, a gain of 0.7%. And that was driven in large part by a big jump in car purchases. And when I think of vehicles, I think of that category as being very interest rate sensitive. Make sense of that for me.
Well, that is true. Clearly, the low borrowing costs, especially post-COVID, I think did sustain the auto industry in what would have been more difficult times. But I will say, if you look at the consumer wealth that has been attained more recently, whether it's the equity markets, clearly really, really strong gains there. Those that have invested in crypto, clearly incredible gains there as well. So it does feel as though, even though there are haves and have-nots within the U.S. consumer, and I would say across the country broadly, that goes for corporations as well, it does feel as though there's still a lot of money sloshing around in the system. And so to the extent that folks can afford new vehicles, then it seems as though they have the wherewithal to spend on that.
So a lot of money sloshing around the system. That sounds inflationary. Are we wrong to expect aggressive rate cuts in the new year, do you think?
My base case would be maybe 1 or 2 rate cuts next year. I just feel as though inflation isn't ready to sort of come close to the Fed's 2% target. And I guess the other interesting aspect of tomorrow's meeting will be the dissents, because clearly seems as though a growing number of Fed officials that feel as though we need to make more progress in order to keep lowering interest rates. So again, the dissent votes will be interesting tomorrow as well. But I think my base case, again, is for just barely lower interest rates next year as opposed to material lowering of rates.
So do you think that what we've heard in terms of economic policies from the incoming Trump administration, do you think those details, sparse as they may be, would give the Fed a little unease about maybe trying to plan too much in the future?
Well, I will say what has been interesting to me is, the bond market has really viewed the world of, potentially in terms of policy, a little more glass half empty, maybe focusing on higher inflation, possibly from tariffs and immigration policies. It seems though the equity market has looked more so at deregulation in a more favorable tax environment. So I will say I think the two have sort of coexisted so far, but I do think that if rates at the long end of the yield curve move in the vicinity of 5%, I think that it's likely that risk assets and equity markets are going to struggle with interest rates reaching that level.
So how are you adjusting your strategies these days when it comes to putting new money to work in markets?
Well, we focus primarily on the fixed income markets, and we're still sourcing really attractive opportunities. I will say, I think we found a little bit better relative value in the world of securitized credit versus corporate credit, where spreads sit today. But, the all-in yield levels that we're witnessing today, whether it's corporate credit or securitized credit or even treasury rates, really, it's about as good as it's been since the global financial crisis. So again, it's been really attractive new investment opportunities that we're witnessing in the credit markets today.
What's your outlook for the bond market next year when we're talking about things like potential tariffs? We're talking about tax cuts. I mean, these seem to be maybe a little worrisome for bond investors.
Well, I do think it's going to be an interesting time. I do think in some ways maybe the tails of the curve have been expanded. Just, I would say that's possibly to the upside and to the downside in light of some of the uncertainty, some of the disruption that is likely to be implemented under the Trump administration and new policies there. So, I think being good investors, you have to have a level of being proactive and also reactive. And I would say that, next year may be more a case of being able to react to current events that are happening as opposed to, basically setting a game plan in advance.
So, and I'm wondering as well, as long as we're talking about the possibility of fewer regulations, whether we can assume maybe a little bit more in the way of merger and acquisition activity, and if any of that deal making is going to be funded by the issuance of some new debt. What do you think about that?
Well, I think that, clearly M&A activity has really been pretty stagnant. So, but clearly, I would say this administration is going to be much more M&A friendly. So, that does, I would say, increase the possibility of more debt issuance. But I will say, the corporate credit markets have been incredibly wide open this year. So both investment grade and high yield credit spreads are really approaching or at the tightest levels we've seen since the 1990s. So even given the level of interest rates today, the level of treasury yields, corporate borrowing is still relatively attractive if you compare it to longer term historical metrics. So again, I would expect M&A debt activity to increase, but I will say a lot of issuers have been able to take advantage of the tight credit spread environment and basically push out any near term maturity. So we think the opportunities for defaults is likely to be somewhat diminished as a result of all the refinancing that's happened this year.
At what point on the curve are you kind of focused? More so at the shorter end?
Yeah, I mean, I do think that, longer term, the yield curve is likely to steepen. So I would say sort of that intermediate, sort of middle part of the curve, the so-called belly of the yield curve tends to do best in a yield curve steepening. And again, given the flatness of the Treasury yield curve, oftentimes your all-in yield levels are just as attractive there as opposed to opportunities further out the curve. So again, we think on a risk-adjusted basis, it makes sense to be sort of in that intermediate duration debt maturity spectrum.
Mark, good stuff. We'll leave it there. Thank you so much for being with us. Mark Heppenstall, President, CIO at Penn Mutual Asset Management, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.